They just changed the rules to stop us. The bank's kill switch officially failed today. What if the silver market didn't T-move because traders sold? What if it moved because someone pulled a lever while you slept? That's the game. It's never loud when it matters. It's quiet. It's administrative. Late Friday, after the headlines died down and before the weekend really began, the rulebook moved. No new metal, no new supply, just a higher price to keep your seat at the table. They did the one thing that works even when metal is scarce. They changed the rules. If you woke up, checked your phone, and saw red candles, if you watched silver get smacked down from the highs and felt that old fear rise in your chest, stop. Because that drop wasn't the market discovering a price. It was a pressure tactic, a controlled shock, a warning shot. Overnight, the exchange raised margin requirements on silver futures, making it 50% more expensive to hold the same position than it was yesterday. And here's the part most people miss. This isn't a rumor chain. Margin changes are posted as official notices. Cold, boring PDFs that move huge money with one line. I'll pin the notice in the description because the story always starts with paperwork. And that's the part that should scare you, not the chart. The paperwork. Because when a market can move an entire price with a PDF, you're not watching supply and demand. You're watching permission. And permission, once revoked, doesn't ask whether you were right, only whether you paid enough to stay. The goal was not subtle. Force liquidation, crush leverage, purge the weak hands. Break confidence before the weekend, when narratives spread faster than orders. This move has a name on trading desks, a margin trapdoor. We've seen the movie. In 2011, margin hikes like this helped slam silver about 30% in a week. In 1980, rule changes and margin pressure were part of a collapse of around 50%. Same logic every time. Don't fight the price with metal, fight it with rules. Here's what makes this so brutal. The silver futures arena is built like a casino. The public thinks the price of silver is set by people swapping coins. Wrong. The price is set by leveraged contracts, by speculators controlling huge value with small cash. One COMEX silver contract controls 5,000 ounces. At roughly $63 an ounce, that's about $315,000 of silver. But until yesterday, you didn't need anything close to $315,000 to play. You needed margin around the low five figures, about $12,000 in the example, roughly 25 to 1 leverage. That leverage is the rocket fuel behind fast rallies. It's also the kill switch. Think of it like a poker table, where you were allowed to sit down with $12,000 and play a $315,000 hand. You're not holding silver, you're holding permission, and the exchange controls the permission. Most traders don't realize this until it's too late. You done it and you own a leveraged position. You rent it, and the landlord can raise the rent overnight. Now picture what happens when the CME changes the buy-in at 2 a.m. Say margin jumps from $12,000 to $18,000 per contract. Only $6,000 more, right? Not if you're holding 1,000 contracts. Yesterday you needed $12 million posted. Overnight you need $18 million. Find $6 million immediately, or your position gets sold for you, and you don't find $6 million at 2 a.m. So the system sells automatically at market. Not because silver suddenly became worthless, not because fundamentals changed, because the house rewrote the entry fee and the computer enforced it. That's the key distinction. This isn't people changing their mind about silver. This is people getting kicked out of the trade because they can know how to meet the new entry fee. That forced selling wave is the entire point of the margin trapdoor. This wasn't silver getting weaker. This was the rules changing in the middle of the night. That's why it feels personal, because it is. The market didn't vote. You didn't get a warning. One update, and suddenly your position is illegal unless you pay more. And today, something happened that should make the biggest shorts sweat. This was a 3-second test. The moment you saw red, did you flinch? Or did you ask why it was red? That split second decides whether you trade narratives or understand mechanics. It didn't break the market. It dipped, and it held. When price drops, fear spreads faster than facts. One trader sells, the next one panics, and suddenly you don't have a dip. You have a stampede. That cascade isn't an accident. It's the mechanism. And it's exactly what they engineered in May 2011. Back then, silver surged into the high 40s, tagged the $49 area, and the crowd was drunk on momentum. Then the exchange reached for the lever it controls best. Not the price, the margin. In 2011, CME raised margins 5 times in 9 days, requirements up about 84%, and silver slid from roughly 49 to the mid-30s within a week. That is the playbook. And the reason it works is simple. Leveraged markets don't a T-break because people change their minds. They break because people can't meet the new deposit requirement when the house raises the buy-in. That's why the up margin hike, this week's 50% jump, that matters. Historically, the CME doesn't need one dramatic move. It often hikes in 10-30% steps, stacked back to back, until the weak hands are forced out. Same weapon, same logic. Only the calendar changes. But here's where 2025 refuses to behave. They saw the breakout above 60. They saw the stress in inventories. There are signs the wrong side of this trade is under stress. So they pulled the lever, raise margins, flush the leverage longs, scare the crowd before the weekend. And yet the price didn't collapse. It slipped, and it held. Why? Because the buyer base is different now. In 2011, the rally was powered by paper, hedge funds, futures leverage, SLV options, while physical metal was available and vaults weren't under siege. Kill the paper demand and the price caves. In 2025, the bid isn't just paper. It's industrial and sovereign money, cash buyers who don't care what the margin clerk thinks. Tesla doesn't buy silver on margin. A government stockpiling metal doesn't get a margin call. And that's why, instead of a brutal 10% day like 2011, today looks like a shallow pullback, less than 1%, more like consolidation than collapse. The trapdoor still kills speculators, but it doesn't stop a physical buyer. And that's the shift the system doesn't want to admit. You can jack up margins on paper contracts all day. It won't conjure a single ounce of physical silver into existence. It won't help Samsung solder one more solar cell. It won't restock a London vault. That is the point people keep missing. A margin hike is a weapon designed for a paper battlefield. But what's unfolding now is a physical fight. And you don't win a physical shortage with rule changes and spreadsheets. That's why today's reaction matters. The market took the hit, absorbed it, and kept its footing. If the old trapdoor can't force a real breakdown anymore, then the paper market is losing authority. The physical market looked at the hike, shrugged, and kept buying. So what did the trapdoor actually accomplish? It didn't end the rally, it set a trap. Here's how the trap works. COMEX silver is built on leverage. When the exchange raises the buy-in overnight, the weakest positions get liquidated automatically. A bear trap is when price is pushed down just far enough to scare sellers out, then snaps back hard. The goal isn't the drop. The goal is the reaction. That red candle is bait. The weekend crowd sees the headline, sees silver slip under $64, and their brain completes the story. Top is in. So they hit, sell. Some even flip short, convinced they're early to the next crash. And that's the real question. When that forced supply hits the tape, who's calm enough to buy it? Not panicked retail. Retail runs from red. The buyer is colder. An algorithm, an industrial desk, a sovereign pool of cash sitting with limit orders like a bucket under a shaking tree. They wait for liquidation to spill supply, then they scoop it. That's the springboard. Weak leveraged hands get flushed. Ownership transfers to strong hands. And when price snaps back, when it gaps toward $65, the late shorts are trapped. They buy back at a loss, and their buying becomes fuel. The trapdoor didn't kill the move. It cleared the leverage and reloaded the cannon. A base built on physical demand is steel. A spike built on paper is glass. Today showed you which one you're standing on. Because Friday isn't just a close, it's a headline. Whatever the weekly candle looks like, it becomes the story people repeat all weekend. Here's the real reason they chose Friday. Not because of charts, not because of technical levels, because the weekend is the one stretch of time when their paper grip loosens. COMEX shuts down Friday afternoon. For roughly 48 hours, the Western paper machine can't actively lean on the price. But the world doesn't pause. Cargo moves. Deals get cut. Headlines hit. And when the Middle East and Asia light up on Sunday night, trading reopens in a different mood, in a different time zone, with a different agenda. That's the danger. If silver closes Friday at or near a new high, it doesn't just look good on a chart. It broadcasts a message to desks in China and India. The West is struggling to contain the move. That message invites a weekend gap, an ugly, violent gap, when markets reopen. Banks know this. That's why they fight hardest at the weekly close. They're not just trading price, they're painting psychology. Because charts are memory. And the weekly candle is the screenshot people carry into Monday. And once Asia reads that candle as weakness, the next open becomes dangerous for shorts. Let's recap the crime scene. Overnight, the CME raised silver margins 50%, the same category of weapon used before. In 2011, silver topped near $49. The CME hiked margins 5 times from April 25 to May 5th, total requirements jumping about 80 to 85%, and price fell into $34.35, roughly 30% in a little over a week. In 1980, after silver peaked near $50, exchanges tightened the screws, including liquidation-only conditions, and the market suffered a historic collapse. The lesson is the same. When the house can't fight the price with metal, it fights it with rules. That's the history. That's the threat. But today, silver is sitting around $64, down barely 1%. So the trapdoor didn't do the job, which means the story isn't over. The divergence is widening. The paper price is being managed, but in the real world, A different bid is quietly building. And next, we follow that bid into the real world, where physical demand actually lives. So the trapdoor failed. That's not a footnote. Because if raising margins doesn't break the rally and physical supply is already tight, the regulators start running out of clean weapons. The playbook narrows. Two cards remain, and both are ugly. The first is position limits. The exchange can announce that no single entity is allowed to hold more than a certain number of silver contracts. It will be sold to the public as preventing corners and protecting stability. That's the label. The target is something else. It's not the small trader with a handful of contracts. It's the big pools, ETFs, large funds, family offices, anyone sitting on size that can be tied back to physical metal. Force them to cut positions, and you manufacture selling pressure without touching the fundamental shortage. It has the same trick in a cleaner suit. You don't change the price directly, you change who is allowed to participate. The second card is worse. Liquidation-only mode, the historical turn-off-the-buy button maneuver. For a set period, say 30 days, traders can only sell existing contracts. And if that happens, here is what I'll notice as a normal person, spot on the screen might look cheaper, while physical gets harder to actually buy. Phone calls take longer, premiums widen, delivery dates slide. That's what decoupling feels like in real life. No new longs, no fresh demand. If nobody's allowed to buy, the paper price can only drift sideways or slide down. In that world, futures could print $50, even $40 on paper. Not because silver became abundant, but because the market was handcuffed. But here is the catch they can to raise with a rulebook. Buyers Don-T vanish when you ban them from COMEX. They relocate. They go to Shanghai. They go to London OTC. They go straight to physical dealers and private supply agreements. That's where the great decoupling accelerates. Paper silver at $40 because buying is disabled, while physical silver trades at $90 because industry and sovereign cash still needs it. We've seen retail premiums blow out over spot in tight periods, even while paper drifts. A wide spread becomes possible when paper trading gets handcuffed while physical demand stays real. It absorbs what happens. When a paper venue tries to price a physical good, it can deliver, and the physical pressure isn't theoretical anymore. In parts of the world, we're already seeing signs of strain. Spot prices pulling away from futures, availability tightening, and products quietly becoming harder to source. This isn't speculative demand. This is real metal being pulled forward by real users. Industrial demand doesn't negotiate with margin policy. If COMEX prints $40 while real metal clears at $90, no miner sells into COMEX. Why would they? They sell where the real price is. Vaults drain toward zero. The exchange keeps trading, but it's trading paper ghosts, claims detached from metal. A zombie market. That is the regulator's trap. Leave the market alone and silver runs toward $100. Interfere too hard and you destroy price discovery and lose control entirely. Damned either way. And that's why a failed trapdoor move is such a loud signal. It shows the casino is losing the ability to rig the game without burning the building down. Step away from the chart for a second and ask the only question that matters. Why are you holding silver at all? Are you holding it to win more dollars? Or because you can see the dollar itself is cracking? Everything you watched over the last 24 hours, the margin hike, the volatility, the sudden red candle wasn't a price discovery. It was noise. It was a stressed system swinging its arms in the dark, trying to regain control with procedures and paperwork. That's what empires do right before they admit they're weaker than they look. The physical reality didn't change, not even a millimeter. Start with the ground. Silver is not endless. The easy ore is gone. Grades fall, new discoveries are harder, and you can't ramp production the way you ramp a server farm. You cannot print silver. You cannot legislate new deposits into existence. Then look at the future the world is building. The energy transition isn't a slogan, it's hardware. Solar, EVs, semiconductors, medical systems, data centers. The modern machine runs on silver contacts and conductivity. This isn't luxury demand, it's structural demand. And when industry buys silver, it doesn't invest, it consumes. It turns bars into components and locks them inside products that don't come back to market. Now add the final layer, debt. The global system is saturated. Governments roll liabilities forward. Central banks patch every crisis with more liquidity, more promises, more paper. Holding physical silver isn't holding a promise. It's holding a claim on a scarce input the world needs and can't counterfeit. Holding paper silver is holding a claim on a leveraged institution inside a confidence game. That's why today mattered. The paper system tried to scream, silver is dangerous, sell. The physical world replied, silver is scarce, secure it. And the market action spelled it out. They tried to set a bear trap, push price down to scare you into dumping, then reverse and trap the late sellers. You saw it in the numbers. The dip hit around 63.80. Shorts leaned in around 63.50. Then price snapped back near 64.09. That's not magic. That's buying power. Where does that buying power live? Not in a public order book. Think of the screen price as the storefront tag. While the bulk deals happen in the warehouse, by phone, in commodities, size moves through OTC channels, especially in London, through private agreements between industrial users and bullion banks. Big physical flows, often in 1,000-ounce bars, don't show up like stock market level 2. They just absorb supply until the tape stops falling. That's why the trap door was really a test, not of silver, of you. Did you panic into the dip? Did you trade real scarcity for a digital promise? Because that's exactly what the system is betting you'll do. Don't give them the satisfaction. So where does this leave us? It leaves us staring straight at Monday. Based on what we've just witnessed, the failed margin strike, the way selling was absorbed, and who was actually buying, the setup is no longer subtle. The forced selling didn't break the market because every liquidation was met by real demand. That has consequences. The market didn't collapse, it compressed. Short sellers who pressed their bets today thought they were reliving 2011. Many leaned in around 63.50, confident the margin hike would do the job for them. Instead, price stabilized near $64 before the weekend even began. Those positions are already underwater, and now they're trapped in time. 48 hours with no COMEX trading, no ability to adjust, while the story keeps spreading. And the story will spread. Over the weekend, physical reality doesn't pause. If reports of tight supply, refinery bottlenecks, and unavailable inventory continue to circulate, anxiety builds fast. People will try to buy silver online and discover the disconnect between screen prices and real metal. Anxiety builds fastest when markets are closed. For 2 days, paper traders are frozen in time. But physical demand doesn't wait for New York's permission. Then Asia wakes up. COMEX may go quiet for the weekend, but Tokyo, Shanghai, and the OTC desks don't live by New York hours. A weekly close holding the 60-plus zone, especially near 64.65, isn't just a chart pattern, it's a message. And that message is read first in the East, when Asian markets open Sunday night, and the US follows. Monday morning, the risk isn't drift, it's a jump. A gap toward $65 is on the table, and if that happens, late shorts get trapped and covering becomes fuel. If it doesn't gap, then watch for the same thing in slow motion, dips getting bought and the floor rising. Either way, today looked less like a top and more like a reset of leverage. Yes, regulators still have cards, position limits, even liquidation only if things get desperate. History proves that. But history also shows what comes next, decoupling. We've already seen it in retail markets, where products like Silver Eagles and Maples have traded at double-digit premiums, sometimes 30-50% above spot. When physical supply tightens, paper can be managed. Metal can't. So go into this weekend clear-headed. 1 ounce is still 1 ounce. No margin rule can change that. Screens flicker, vaults don't. Quick claim versus fact. Fact, margin changes, force leveraged liquidations. Fact, this tactic has shown up before in silver. Claim, this time the dip got absorbed because the buyer base is shifting toward real demand. That's the lens. Now tell me yours. If you've got counter data, drop it in the comments. I'll read it. If this kind of deep dive helps you see the system more clearly, subscribe so you don't miss what comes next. And I want to hear from you in the comments. Do you think Monday opens with a gap higher? Or do the exchanges still have one trick left? Stay sharp, stay grounded. And I'll see you on the other side of the weekend.